Welcome to Crashes and Taxes, everyone. I am your host for this podcast, Rebecca Walser, and I'm so excited that you are joining me. If you are joining me via sound only, you might want to consider joining this podcast later because I am going to be adding some slides to this podcast and walking through some things to explain some things that are going on in the world for you guys. So I am getting over a little cold, so I hope that you guys can deal with my voice. But I wanted to come to you today. I've been extremely busy, as you can imagine. The market is going crazy. The world is going crazy. So my practice has been very busy, and it's been a little bit of a challenge to keep making sure that I'm always available to do crashes and taxes. But I love it. It's very important. So I want to share with you guys what's happening, what's going on. So the first thing to know is I'm coming to you today, Friday, April 1st. I don't know when the podcast will actually be able to get uploaded from my producer. So that will be when it comes out. Know that I recorded it today, Friday, April the 1st. And the reason I'm telling this is I want to give you some market information. So the market is so volatile, it will change by the time that, this information gets out there. It will change by the time this is produced. And so I just want to let you know today, the S&P year to date, so through April 1st, the S&P, the market is closed now. The S&P has lost 4.62% year to date, so not super bad. NASDAQ is doing the worst. It has lost 8.94%, so let's call it 9% year to date. S&P is about 4.5%, NASDAQ's 9%. The Dow has lost 4.18%, so let's call it 4%. So we've lost 4.5 on the S&P, 4 on the Dow, and 9 on the NASDAQ. So truly, in all ever sense of the word, not terribly bad so far. And so what's happened is the market has had one period of time where really we saw it come down, and I started to think, okay, this might be the beginning of it. But we've had almost what I would call a dead cat bounce. And what a dead cat bounce is a period of time where the market really has all really poor fundamentals, and you fully expect that the market will have a refractionary downward period. And then all of a sudden you see, for no understandable economic reasons, the market doing very well. And I think that's exactly the circumstance that we're in right now, a dead cat bounce, where you're going to see the market potentially try to pull up. But there are just too many headwinds. We will not, in my professional opinion, escape 2022 without a substantial market pullback. Now, that does not mean that the market will not recover once things settle out. But the settling out is the problem that we don't know. So let's go through the slides that I want to share with you and kind of give you an update as to where and what's happening. The first thing to note is that we've had some inverted yield curves. So what an inverted yield curve is, because people always, want to know, well, what does that even mean, Rebecca? What is a death cross? What are these things? And if you're not a technical trader, or you're not a market person, you're not going to know what these things are. So I want to talk about what the market yield curve inverted this week multiple times, including today. And what happened is the 2-year basically has a higher yield than the 10-year. And or you could have a series of different, you could have the 10-year invert to the 30. That's very rare. But, the reason the yield curve is a problem for economists, and what you're going to see now is a bunch of economists come out and say, yeah, but the yield curve, is a leading indicator by 600 days or 2 years or 500 or 300 days or 1 year. You're going to hear all that. This isn't going to go that way. Not this time. There's too many other things happening than beyond just a yield curve. But if you think about it, it really is the spread differential that's the problem for a yield curve. Why is a yield curve suddenly showing us recession in the near-term future, whatever future that might be? And the reason is, think about it. If the Federal Reserve, or if a 2-year is paying you higher yield than a 10-year, then there's no spread for the Fed. No spread for the Fed. That's the problem. If there's no spread for the Fed, that means banks aren't making money. That means that what our prices are today are higher than what is going to be happening in the future. So we actually we see recession coming, because our immediate costs are actually, and our immediate returns are actually projected to be higher than what the Fed would be paying 10 years from now, which means there's no spread for the Fed. And there's no spread for the Fed, that's indicative of the fact that we could be moving towards a recession because the current price structure and economic structure is a problem. So let's move forward beyond the yield curve. And let's look at this. This is an article out of one of the publications I track, and it's talking about, this was published March 21st, and it says Wall Street's biggest bear. And the quote is, "This is a vicious bear market rally to sell." And it noted that expects stocks to drop another 10 to 20% by mid-April. And then the article goes into the reason as to why the stocks will be dropping even further this month. So there are reasons. We're going to go into those reasons now to sort of prepare you. So here's the very biggest thing that's happening. As the Western culture was so fast, and I'm talking about Europe and the United States, to sanction Putin's Russia for Putin's aggressive action into Ukraine, what we didn't stop to realize was we could, in fact, we're so arrogant. We're arrogant. America's arrogant. And we're going to have to reconcile with that. And it's hard for me because I love this country and I'm a patriot all the way. But we've become arrogant. We decided to go ahead and sanction a country that is a world superpower, from a nuclear power perspective. We decided to sanction them and get them out of the SWIFT international payment system. So when they lost SWIFT, and then you had two private companies, Visa and MasterCard, who then also decided to exit Russia, then you had Putin left with no choice but to take the actions that he's now taking. And the actions that he's taken, well, first of all, we have to understand that Putin and China had already become a little bit cozy, and they had already had some alternative Chinese payment processing systems outside of MasterCard and Visa. But what Putin had also done, besides build up a big gold reserve, what he had also done is get ready for a financial system outside of the US dollar. And so now what we see is Putin has, as of today, April 1st, declared that they will no longer sell any of their energy sources, natural gas or oil, to Europe, of which Europe as a whole relies 57% of their energy, all energy, 57% of all energy comes to Europe. And I'm saying Europe in general, but mostly Germany, for example, and 57% is coming from Russia. And Russia is now saying that as of today, April 1st, they will no longer sell any energy in any form outside of it being sold either in rubles or dollars. They have pegged their currency to rubles or gold. They have pegged their currency to gold, and they are willing to accept either rubles or gold. So either Europe has to pay Russia in gold, or Europe has to acquire Russia's currency and pay Russia in its currency, which will what? Yes, it will make the value of Russia's currency go up. And what will happen to our petrodollar? You have to realize that Henry Kissinger flew to see the King of Saudi Arabia in February of 1974, and they worked out an arrangement such that the United States would provide military protection for Saudi Arabia in return for Saudi Arabia guaranteeing that OPEC producing or OPEC nations would sell oil exclusively in US dollars. That was the trade-off. That was the exchange. That's how the petrodollar came to be. And what you see now is that it's over. It's ended. It's over. Because we now know that Saudi Arabia is in negotiations as we speak with China to sell oil to China in Chinese yuan. We also know that India and Russia are talking, and that India and Russia will be potentially executing trade in rubles as well. We know that Europe has to accommodate Russia because they can't go without energy, especially since they rely on the majority of Russia for their energy. So what do we have with these announcements? We literally have India, the second most populous country on planet Earth with close to 1.4 billion people. China, the most populated country on the earth with 1.5 billion people. All of Europe, depending on Russia. And so what is that? What are those three? Europe, Russia, China, and India. That is well over half the population of the earth. India and China alone are just under half of the total population of the world, the global population. So what we have done through our reactions to Putin's actions going into Ukraine by getting them out of the SWIFT system, instead of cutting them off at the knees, we have basically now made more than half of the earth get their oil outside of the US dollar, ending the petrodollar as we've known it to be since 1974. There's a lot of speculation on what this means. Why is India buying more Russian oil? What you can see is I'm pulling up a variety of sources here. So I've got obviously market sources. We've got Zero Hedge here on petrodollar. We've got, I just want to point out that we are leveraging multiple sources. Al Jazeera here on Russian oil. We've got the BBC, which is out of obviously the UK for the Ukraine. And then I wanted to point this out to you. This is the SEC. The SEC, and it is basically a statement from the SEC, from the Trading and Markets statement. And I want to read this to you. And there is a disclosure here. It says this statement represents the views of the staff. It is not a rule, regulation, or statement of the SEC. The Commission has neither approved nor disapproved its contents. The statement, like all statements, has no legal force or effect. It does not alter or amend applicable law, creates new or additional obligations for any person. This is a statement from the SEC Division of Trading and Markets, staff of the division, dated March 14th. Staff of the Division of Trading and Markets, staff urges broker-dealers and other market participants. Broker-dealers are the ones that settle the trades on the S&P, on all of the market exchanges. So broker-dealers are executing trades, settling trades, and they are saying, and of course they allow people to have trade on margin and those kinds of things, and they're saying here, they are urging broker-dealer and other market participants, like, for example, my firm's an RIA, a registered investment advisor, to participate and remain vigilant to market and counterparty risks. To market and counterparty risks that may surface during periods of heightened volatility and global uncertainties. It is always prudent that broker-dealers have strong risk management practices. In particular, broker-dealers should be mindful of the following. They should collect margin from counterparties to the full extent possible in accordance with any applicable regulatory and contractual requirements. They should watch concentrated positions of prime brokerage counterparties that pose particular concerns. Staff urges broker-dealers to seek sufficient information to determine counterparties' aggregate positions in any markets that may experience liquidity concerns and work with counterparties to mitigate risk. SEC staff urges broker-dealers to stress test positions with proper severity in light of current events and potential market movements, and to act to manage the risk of the positions, particularly those that are concentrated, appropriately. Staff urges broker-dealers to monitor risk management limits calibrated to the financial resources of the broker-dealer, closely watch intraday, and escalate any breaches promptly to senior management. So why am I pointing this out to you? This March 14th Division of Trading and Markets TM staff statement published on the SEC website. And I think it's very obvious that the reason is that we literally are in unprecedented global times, to the extent that we have concerns from the SEC ahead of these market corrections coming out and stating, if you don't, you need to collect margin on your margin accounts. You need to make sure you're not too concentrated in any one position. You need to make sure in a period of extreme volatility. This is about as close as we can get of a public acknowledgement from the SEC staff that we are in unprecedented times. You know, Russia's incursion into Ukraine is not Afghanistan. It's not Iraq. It's not Libya. It's not a country that started to say one thing and then we had an altercation. This is a global superpower with hypersonic missile capabilities and nuclear weapons. It is not for us to just rush in my opinion, from a global economy perspective. It is not our position that we should have we should have thought through what Putin's offsetting moves were going to be that could potentially jeopardize the stability of the West, and specifically the stability of the United States dollar as the world reserve currency. You have to understand, we became the world reserve currency at the end of World War II with the Bretton Woods Agreement. But it wasn't until the rise of the petrodollar that the dominance of America as the world reserve currency was felt, because as countries were forced to buy our dollars to buy their oil, we were able to spend almost half. Last year, we spent about over $7 trillion and we collected $4 trillion in taxation. So that leaves us $3 trillion uncollected that we got from somewhere. Where did we get it? Because people had to buy our dollars so they could buy oil. Countries around the world have had to buy our dollars so that they could buy their oil. And as that ends, we easily move to what the IMF has wanted for the longest amount of time, which is the end of the US dollar as the sole reserve currency. And we move to a basket of SDR, special drawing rights. Those are made up of the US dollar, the UK British pound sterling, the euro, the Japanese yen, and the Chinese yuan. So it's a basket of 5 currencies. Those are the currencies. That would be the basket. And China was added to it several years back. So as the dollar begins to become apparently not useful in buying oil anymore, we will start to see the beginning of the changes that I've been warning you guys about, that the central bank was at the tipping point and wouldn't be able to contain the losses or to stem the problems that would come. And this has escalated that process astronomically. I don't want to say everything I would normally say because it's actually too frightening and scary. This is the most precarious position. This is the most precarious position our country has been in since World War II. Financially, economically speaking, since then, for sure, without a doubt, because of the nature of the collapse of the petrodollar and the impact that that will have on the United States. We just are unaware yet. But there's that. And then there's the fact that we are potentially being or entering into a global war with another nuclear superpower. So from a geopolitical perspective, this is a very, very rocky time. And unfortunately, we have an administration right now that will say things publicly, and then the next day, the actual staff of the president themselves is walking back what this person is saying. So that makes me a little nervous about being in such a geopolitical precarious situation. That is tied to the economic precarious situation that I'm pointing out to you. And that is also tied to the fact that I don't want you, the market has had a very rough go of it for sure. But understand that we haven't really had a substantial loss yet. We just got the feds to raise the rates, the federal funds rate, for the first time this past month. And we're expecting 6 more rate hikes, as Chairman Powell has announced. So as we're raising rates, as if things are normal and monetary policy is normal, to stem the tide of inflation, we're actually seeing in front of our faces the end of the global dominance of the petrodollar. These are unprecedented economic times that we have not been through in modern time. Again, we became the world reserve currency in 1944, but it wasn't until literally February of 74 where the petrodollar rose to the prominence that it has. And the other thing is, keep in mind, we were on the gold standard all the way until Nixon fully took us off in August of 71. So we have not had a time where we have been off of the gold standard, and we have not had a globally accepted currency that's backed by a substantial amount of gold, i.e. the dollar, that the world moved to. We have not moved off of that since 1970s. So we're an unprecedented 50-year time frame here, 50-year jubilee, if you will. And I just want to caution you that the market is going to have a tremendously difficult time navigating through this with upside improvement. We have had some hyperinflation into the market. I don't have a market slide, but you guys know that the recovery has been straight up since Corona. That indicates in and of itself, the slope of the line indicates that we have an inflationary bubble. And now that all these developments are coming, I just want you to prepare yourself, brace yourself. Not only have we had enough troops for NATO, 40,000 troops positioned in positions of potentially war, and the equipment that's moved over there, with the amount of equipment movement and the troop movement that has been coordinated between NATO and the United States, it's going to be very difficult to see how we exit this situation without some kind of global war. And I can't imagine that because, global war at this level, at this advanced stage, how does that not turn nuclear? You had Putin say, one of his defense ministers say that they would definitely consider using nuclear weapons. And you had Biden saying he would consider using nuclear weapons. We're both considering nuclear weapons. So we're on an even playing field of not calling off the nukes and not taking the nukes off the table. So I don't like to be a scary fear monger. That's not my job. And I hate it. I hate having to come on and give you all this negative information that's just god awful depressing, because that's what it is. But we are endeavoring always to be real and true and to not be fake and to always give you what is the facts. The boots on the ground, the equipment has been moved in place. They are potentially ready for World War III. I don't know about you, but knowing that I see that with the aggregation of defense and military, alignments, I'm going out to the store because I remember when Corona happened and the toilet paper became an issue. The second the world realizes that this could potentially go to war, right now we have Russia saying they're going to exit on May the 6th or May the 9th or whatever the date is. Like the war is just can be declared to be over. We have the Ukraine saying, okay, you're going to give us back Donbass. Okay, fine. We can have some talks. Again, NATO has moved into position. It looks to me like they want to take Putin out. That's what I am surmising. Based on the movements of troops and equipment, it looks like it will not just be over and Putin can just go back and do whatever he's accomplished. And that's what I pray against. And I pray that will not come. But I will say, if you look at Venezuela, when the currency collapsed in Venezuela, if you look at the top 10 items that were bartered for, because remember they had no currency, so now they're moving to a bartered system. They're the most, and let's see if I can get the list correct, the top 10 items of bartering in Venezuela. Number 1, it was rice. Number 2 was surprising, was laundry detergent. Number 3, of course, toilet paper. Number 4 was, I think, cooking oils. Number 5 was flour. Number 6 was, I believe, deodorant, surprisingly enough. Bread. I know I'm missing some. Diapers and female products. I'm sorry, I'm missing 2. But I gave you a lot. So those you could start with. You just want to make sure that if the world starts to go crazy, that you don't have to go out and get your food for the next 3 nights. You need to probably have a little bit. It's funny, in America, we used to have basements that were full of food. They were like food pantries where if you had enough canned goods that I remember my great grandmother, my gosh, she had an entire basement full of all kinds of vegetables and fruits and just canned everything. You could live like that through a situation, but we don't live like that in America anymore. We don't stock our basements unless you're a prepper. You don't stock your basement full of food. And most of us go to the grocery store a couple times a week and sort of either eat out or, make it at home a few times a week and have kind of do a kind of a hybrid lifestyle. That's most Americans these days. That's why we have so many restaurants. So we're a service-based economy. We are service-based. We offer services and we get paid for services and we pay for services, whether it's, restaurants or concerts or bars, or we are a consumption of services economy. And, moving back to where we have to depend on ourselves and have our own food source for multiple weeks at a time, that's unheard of. Who does that anymore? I noticed that the stock price for emergency food supplies is skyrocketed. So I just want to give you this crashes and taxes, you guys. I'll close it up now. I just want you to look around you. If you're questioning what's going on and you're not getting the answers, because remember, 95% of all websites and cable channels are owned by the same 5 media corporations. I'm not kidding you. So if we're not getting all of the information that we should be getting from our media at home, we need to keep looking. We don't just accept what they say at face value and stop looking. We've learned enough in these last 2 years to know that is not the way it goes. We need to keep looking. We need to get to the bottom of what's happening, and we need to prepare ourselves, because nobody wants to start a mass panic. But the conditions right now are the worst for the dollar. Unprecedented, terrible, worst conditions since we became, the petrodollar in the 70s. And from a stock market perspective, on top of that being the case, we have this potential global war escalation, which the markets do not like war. They do not like uncertainty. So these are all the concerns that we have. And this is why we want to stay safe, cautious, and be prepared. I hope that was helpful for all of you. And until next time on Crashes and Taxes,